Let's talk about secondaries. In the secondary market, there's a great opportunity to take advantage of people that don't have a choice. They have to sell or they need to sell. And not since the global financial crisis have we seen this kind of a compelling return opportunity. So let's make sure we're all on the same page. What is a private market secondary? That is where a limited partner needs to sell something that they own in the alternative industry, and they're going to sell it in the secondary market. Primary market is when you go directly into a fund. Secondary market is when you sell it afterwards to somebody else. How does it work? An LP-led secondary is where an LP says, hey, I need to sell something. They'll usually hire a broker. That broker will find them a buyer. They want to sell their position. They got to find somebody to take it, and they've got to sell it to someone who wants to buy it. So when the buyer buys it, they step into the shoes of that selling LP. They get all the future benefits and all the economic value of that asset that they acquire, whether it be a portfolio or a single asset. And information matters a lot here. Again, don't be a tourist. You have to know what these things are really worth because different sponsors approach valuation and reporting quite differently. So it's very important to have an information edge if one is going to participate in the secondary markets. So why do secondaries exist? This is a common question we get. 1% to 2% of the private equity market sells every year. Why do they sell? Maybe they just need to rebalance. Maybe they've gotten out of line with their investment policy statement. Maybe they just have some assets that they don't want anymore or they don't need anymore. Maybe they have a change in management and the new management wants to put their stamp on the portfolio. Maybe they have regulatory pressure. As an example, in energy, we know of some schools where the students have said if they don't divest of fossil fuels, those students are going to walk out. So they have to sell. You could have something to where they're out of time. They just have to meet a deadline. Most of the time it's because they just need liquidity and they just need some cash. Well, that provides an opportunity for people like us who are buyers, who can find sellers who don't really care that much about price. They just want to get out. Well, that usually is a good opportunity for us to buy it at a very, very attractive price. So why is it that some of the most sophisticated investors in the world like buying in the secondary market? In order to understand that, we're going to use an analogy. We're going to talk about a farmer. So imagine you're a farmer. You go out, you buy the land, you plant the corn. Then you're going to help that corn grow. You're going to harvest your field. You're going to sell that corn. Well, obviously, while you're cultivating, while you're planting, you're spending money, but you're not selling anything. So you literally are in a position to where you're going to spend money on fertilizer and on water and on labor, etc. And you're going to lose money for a period of time until you ultimately make a lot of money come harvest time. Well, that's true for a private equity fund. And this is somewhat true for other private asset classes, but I'm going to focus on private equity. Let's say you invest in a private equity fund. Day one, you don't know what you own, but you know they're really good at what they do and they're going to go out and buy assets for you. And they're going to go then plant that field. They're going to then cultivate that field for you. Then what they're going to do is they're going to harvest that field at the appropriate time. Well, you've got to ride through that J curve where you have to wait for them to lose money first before they make money. That's normal and it's okay to do that. But perhaps there's a way to shorten that. And so when somebody invests in a secondary, buys something, a private fund like this, a private equity fund like this, they're able to then shorten the time horizon. So they potentially have no J curve at all, or a small one, and they're much closer to the path to the return of their capital and their profit. And in many cases, you get to put capital to work a lot faster, and you don't have to worry about what you're going to own. When you go into a regular private equity fund, and this is okay, but you don't know what you're going to own. In this case, you get to pick what you get to buy. If you like the assets, you buy it. If you don't like the assets, you don't. So you eliminate most of what is called the blind pool risk in that fund. You potentially can buy those high quality assets actually at a discount to what they're worth today. And it's a growing market. Because of the growth of private assets as a whole, the secondaries market is growing as well. Again, if it's 1% to 2%, if that pie gets much bigger, that 1% to 2% is going to be a bigger number. This shows since 2002, you've seen a 20% compounded annual growth rate since that time. It's a very interesting question because people are going to look on the far right here and say, why was there less secondary transactions in 2022? It's actually pretty simple. When prices dislocate, the first thing that happens is nothing or very little, because the sellers don't want to admit reality. The buyers don't want to overpay for assets, and so the market kind of freezes. So you see this step down, just like you saw in 2008, 2009. You see a step down first, but then all of a sudden, just like that home example where a bunch of people in the neighborhood need to sell, once somebody starts lowering the prices, everybody else has to follow. That's what happens in secondaries, which creates massive opportunity for buyers. So why now? We're seeing disrupted markets. Obviously, there's not many people harvesting their field right now. So there's not a lot of options for liquidity for LPs. You also have higher interest rates, which drives so many decisions. You also have the denominator effect, which is simply stated that if your public market assets have gone down a lot and your private market assets have gone down a little or not much, well, now you're overweight your private market assets. And so you have to sell some of that and buy what you're underweight now. And oh, by the way, if somebody works for an endowment or a foundation or a pension and they get out of line with their investment policy statement, they get fired. Well, guess how important it is for them to get the perfect price when they're selling something in the secondary market? If they're more concerned about their job, they're a lot less price sensitive. So that creates enormous opportunities because of the forced selling that is happening in the industry today, which is why we're seeing prices really begin to adjust. You've seen a significant drop in both buyout pricing and in venture pricing because of this supply overwhelming the demand that's available to buy it. Plus, if you buy it right after a dislocation in the market, like we believe we're getting close to the end of, you have the best returns. This shows by vintage. So 2009 vintage, no surprise. Private equity secondary funds had the highest multiple on invested capital they've ever seen. Good time to be a buyer in the secondary market after the global financial crisis. Just the same, the highest internal rate of return, which means they got money back faster and in more magnitude. When you add that together, it's a great time to be a buyer in the secondary market.